Hey, what is happening, bulls and bears? My name is JJ. You're watching Bull, Boom, Bear, Bust. It is Thursday, September 7th, 2023, back with another dose of economic reality. And we've got some really good economic news to get into today. First of all, something significant just flipped, and we're going to talk about that here in just a few minutes. First of all, let's talk about what's happening with the stock market. The stock market's seeing a rough week so far. And the rationale that's given behind the weakness in the stock market is inflation being persistent. Like that's some big surprise. Like that's shocking news. Like the markets and investors had no idea that inflation was going to stay this high, and that inflation wasn't going to come down. But we've been talking about that here for 3 years. Inflation's not going to come down. In fact, I mean, let's be technical here. The inflation rate has come down, but what does that mean? That means prices are still going up. They're just going up more slowly, right? So this is not good news for the American consumer that's burning through their savings right now, that's pulling money out of the 401ks like we haven't seen in a very long time, running up debt like we've never seen, the biggest increase in debt. Not only are debt levels at all-time high levels right now, the rate of increase is setting records every quarter that we look at it, right? So pretty alarming, pretty shocking, but really not too shocking when you look at how the banks operate, how the banks can loan out money, even money that they don't actually have, known as a zero reserve requirement. So we talk about that quite a lot here because that's so key, that's so important. And I think that's why so many people, got this wrong, right? All these other people out there, economists and, even YouTube economists talking about how prices are going to crash, there's going to be deflation. Look at home prices are so high, prices are going to crash. Not until you cut off the lending spout. You've got to cut off the lending spout. Remember, back in 2008, banks severely pulled back on lending. That's when you saw deflation. That's when you saw the housing market crash and when prices came down. But we're starting to see some weakness in a couple areas. But first of all, the stock market here down for the week. I'm looking at the NASDAQ, the Dow Jones, every index in the red for the week here. And a recent headline: stocks slide as worries about inflation revive. Revive. Why would they revive? Why would they have went away in the first place? Why would worries about inflation have ever went away? Every time we look at the data, it's bad. Consumers are under mountains of debt right now. 60 to 70% of people living paycheck to paycheck. The consumers are the driver of the economy, folks. This train is going off the rails. It's just in slow motion. And to think that there's investors out there, and when we're talking about investors, the investors that move the markets, the stock markets, are the top 10%. We're talking about the mega institutions. We're talking about the hedge funds, the BlackRocks, etc. The top 10% own about 90% of all stocks, right? So that's who moves the markets. And to think that they didn't know that inflation was going to be this persistent, that's just crazy talk, but maybe that's the case. Maybe they didn't know. But, institution doesn't have to be that smart if they have trillions of dollars in liquidity at the click of a button or at the click of a mouse. You don't have to be smart to make money in that environment. People think these investors are so smart, because they made millions of dollars or billions of dollars. You or I in the same position could make probably just as much or more as some of these hedge funds, right? If you have liquidity at the click of a mouse, if you can borrow, billions of dollars at the click of a mouse to invest, you're going to make a lot of money. And this is a no-lose situation for the banks, right? So will we continue to see stocks weaken? Well, we're still off the all-time highs by quite a lot. And yes, I think the markets are going to have to go down because there's not too many new suckers coming into the market right now, not too many new investors coming into the market. So the big money, they want to take your money, right? The big institutions. They don't just want to take money from each other. They want to take your money. They want the average mom and pop investor to get in at the top, and that way they can sell off and take your money and the average Joe's money. I just think that's how it works, in my opinion. But let's talk about the consumer price index. The Fed was out there saying they're going to fight inflation and we're going to raise interest rates. First of all, even from the very beginning, we knew that was a joke. We knew it wasn't true, because if they really wanted to fight inflation, by raising interest rates, why would they do it so slowly? Why would it be 0.5% at one point, then it dropped down to 0.25%, right? Fractions of a percent of this increase. If they wanted to fight inflation and stop it in its tracks, they would have went from near zero to 10% right away. That would have crashed the economy. Yes, it would have. But it would have brought prices down. We would have seen deflation, massive job losses, deflation. You would have seen a much worse wipeout than 2008, maybe almost Great Depression levels. Of course, they didn't want that to happen. They're not only trying to fight inflation, they're also trying to prevent a severe economic downturn. But in the meantime, since they're doing it so slowly, consumers are getting hammered. That's why we see these debt levels piling up like never before, right? So it's a no-win situation. It's a slow motion economic collapse. It continues. But let's talk about inflation here, not just some people hear inflation and they just think about money printing. Yes, they're inflating the money supply, still printing money out of thin air. But let's talk about the CPI, which is the number that people focus on. And yes, it's way too low, and prices are actually up a lot more than the CPI represents. But we still look at it because when we compare it to the same number maybe a year or two ago, we can see a trend. And right now, we don't have the September numbers out yet. I'm sorry, we don't have the August numbers out yet. Those will be available right around September 13th. But we do have the July numbers. And what do we see? We see the CPI in July 3.2%. That was up from 3% in June. And, we did see it drop down since the beginning of the year. January was 6.4, February was 6, March was 5%, April 4.9%, May 4%, June 3%. Then it ticked back up in July. So what's going to happen in August? So we're going to see it go up again. It's going to be very interesting to find out. We'll keep a track on that. We've got about one more week until that number comes out. But anyways, the point is inflation is going back up. And even when the number was coming down, it doesn't mean prices were coming down. It just means prices were going up not as fast. Not good. Not good. It could be worse. Could be worse. It could be increasing and the prices could be up more than the previous month. But month to month, they've been coming down, but still up. And remember, when you're comparing a number year over year, you're comparing it to a number that was high the previous year, right? So we're up 3.2% compared to last year when the inflation was 7%. So, not good at all. And the consumers are feeling the pinch. People draining their savings rate near all-time lows. People taking money out of their 401ks like we've never seen before, right? So the consumer is headed towards a cliff. Now, something big could happen, and that could divert everyone's attention from the inevitable economic decline. But even if something big doesn't happen, it's only a matter of time because the consumer-driven economy is on borrowed time, considering how fast people are burning through their savings. All right, let's talk about what's shifted here recently in the economy. And we like to look at prices, what people have to pay for things. Car prices are something that we've kept an eye on here for a long time here because that's a gauge of lending. It's a gauge of the consumer in general. New data from IC Cars shows that used cars are taking an average of 49 days to sell, and new cars are taking an average of 23 days. Now that's up quite a bit. That's up over 25% compared to last year. So the rising rates, the tapped out consumer is finally starting to show, in these numbers, right? So we're seeing more cars on the lots, and there's a lot of shadow inventory out there. There's a lot of car dealers that have overflow lots, and they're using some of these vacant buildings from so many of these companies that had to go bankrupt. They're using a lot of these vacant buildings to store overflow inventory of vehicles. And that's one of the reasons why they were able to keep prices as high as they did. There was this game out there and pretending there was this huge shortage. Now, back in 2020, yes, there was a shortage, but even after the supply chains opened back up in 2022 and, of course, this year, 2023, prices still remain really high, and people were wondering why. There's a lot of inventory, but they told you that there was lack of inventory, but there's still a lot of shadow inventory. So we're starting to see the numbers kind of creep back in the right direction, the direction that makes sense, which would be prices coming down, inventory going up, and cars taking much longer to sell. Now, I think it's going to continue to get worse. It's not just going to reverse for no reason. Why? Because the consumer's on the way to being tapped out, and the pool of buyers is really shrinking and almost drying up. So we'll have to keep an eye on that. We'll check on that one, again next month here, and bring in the news as it comes here. Something else that's beginning to rise is the unemployment number. And yes, this is the official number, which is really, really flawed because we have about 100 million people out of the labor force right now. And if you counted all of them, you'd be seeing an unemployment rate of 25 to 30%, right? It's ridiculous. But the official number gives us 3.8% as of August. Now that's actually up. We haven't seen it at 3.8% since February 2022. So we're about at a 1.5 year high. And before every other economic downturn, we see unemployment start to tick up. Once the job losses really accelerate, that's when you see markets come down. That's when you see home prices come down. Home sellers that or homeowners that lose their job, they turn into home sellers very, very quickly when they don't have any income, or when they have to go on unemployment, or when they have to go work at a job that pays maybe half of what they were paying because they got laid off or their company closed or went bankrupt. So we've yet to see that, and that's still all going to be ahead of us. We're still in the early innings of this, and the reason it's taking so long is because of the very slow rate hikes. So they're only delaying the inevitable with these tiny fractional rate hikes. In my opinion, again, they should have just raised it to 10% and then to 15% the very next meeting. Severe recession, crash, falling prices, chaos. I would have preferred that. I just want to get things done, get it over with. Of course, the Fed, they don't want to cause such severe chaos, because then they would get the blame. Because if it happens right after they raise the rates, big rate increase, then everybody's going to know exactly what the reason was. But now with the slow, very slow incremental increase in the rates, they can just blame something else or whatever happens. The new health crisis, this war, who knows, right? What's the next black swan thing to pop up here and cause chaos? We'll have to see, but I think something's coming very soon. Even if it doesn't, though, we're still headed towards a financial cliff, so there's no way of getting out of this. It's either going to happen slowly and continue to happen, continue to play out like it's been playing out, a very slow motion economic shift, or it's going to be fast with something that completely shuts down the markets. Maybe it'll be a war, maybe it'll be a cyber attack from Russia. Who knows, right? But prepare, nonetheless, prepare. I always remind people, keep 30 days of living expenses at your disposal, some money out of the bank, survival food, water, essential items, right? At least 30 days. I try to have 6 months. I think I'm pretty good with 6 months right now. It's not easy though, because just the cost. But actually, let me just try to sum up, what I was saying there. In order to really stop inflation and stop prices from rising, the Fed's going to really need to have interest rates much, much higher. But that would automatically trigger a financial crisis, right? So they're not going to do that. All right, let's talk about the dollar here. The dollar actually has been strengthening. And if you look back since about mid-July, the dollar's up pretty significantly. The dollar index was 99.77 in mid-July. We're up to just under 105 right now. And this is comparing the dollar to a basket of other currencies. And these are all fiat currency comparisons. They're all currencies that are created out of thin air. That's why it's so important to keep an eye on what the BRICS nations are doing, because they're talking about backing up their currency with an asset. In this case, would be gold. So right now that has not been announced. Could that really knock the dollar down once that is announced? Absolutely. That's why we've been really keeping an eye on that. Right now it's just an expansion of the BRICS nations alliance, including many other nations. So it's building, and it's something, again, that's not going to happen overnight. Unless they come out and make some surprise announcement. They're saying, oh, we've got a new currency, it's backed by gold. But see, people still trust in the dollar, right? It's going to take a while for people to lose their trust in the dollar. And I think, with the economic situation that's unfolding, it's just going to be more people losing trust in the dollar, right? So we're going to have to see how this plays out. But right now, the dollar is still pretty strong compared to these other, basket of fiat currencies that are looked at in the dollar index. Let's talk about electric cars for a minute. Electric cars were big, especially in 2020. And with rising gas prices, people want to save money on gas, of course. But 1 in 5 electric car buyers that just came out here returned to gas vehicles because of the huge inconvenience of having to charge the vehicle. And not only that, some states in California, they don't want you to use electricity during certain hours. So charging your car, it's a long charging process there. So pretty interesting. We'll have to see if that number keeps going up. Maybe 2 in 5, if we check in 6 months, maybe 2 in 5 people that had electric cars wanted to go back to gas cars. But we've definitely seen it in EV prices. Electric vehicle prices have actually led the way. And we know Tesla's been really drastically cutting their prices and, leading the market down. But let me remind all of you that the BS detectors are really going off because we've got the central bank talking heads out there. Jay Powell, for example, saying how strong the consumer is. But yet we see credit card and car loan defaults hitting a 10-year high, right? So things aren't adding up. We all knew it. We've been tracking this for years. And, we're on top of it. We're ahead of the curve. We know exactly what's happening. And things are going to play out, I think, just like we are anticipating here, with the exception of maybe a surprise situation that pops up here. All right, shifting gears a little bit here. We've got more layoff announcements. Pretty big one here. This is Roku, the streaming device. Clickety click, 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 click. Laying 10% of its staff off. Another sign that things are not so good. So these streaming devices are very, very popular now, especially for people that don't want to pay for 100 or 200 cable channels. They just want to have certain channels, and you can do that just by getting one of these devices and putting the app for whatever channel you want on the device. So it's a lot cheaper. In fact, a lot of the apps are completely free. Some of them you just have to watch a few commercials, like Freevee, and some other ones. What's the movie one? Tubi. Tubi's another good one. Completely free. Just watch a few commercials. So people that are cutting the cable and also cutting paid streaming services like Netflix, going to a lot of these free ones. So, a lot of people bought these devices, especially when people were at home for a year or more in some cases. And now it's slowing down, and all those jobs that were created, all that boom, the economic boom that we saw with all of the stimulus and with everything else, with the canceled rents, the canceled foreclosures, the pausing of payments for utilities, for credit cards, all those crazy things that happened that gave people extra money to spend. We're now still seeing it play out in reverse with more layoffs. And we haven't even really hit the big layoff numbers yet. Just wait until the consumer gets even closer to the financial cliff, closer to being maxed out on the credit cards, and you're going to see layoffs really accelerate. And that's when you see housing start to come down. Homeowners are going to turn into sellers very quickly when they get laid off. And this is not a fun thing for me to report. I'm just letting you know how this has played out in the past. If you look at the 2008 financial crisis, and that's when the housing market really started crumbling down, very, very quickly. But here's an article here out of Business Insider. Surging mortgage rates and near record home values have sparked an affordability crisis. But here's where it gets interesting. But home prices may keep climbing anyway, one expert says. Folks, that's very unlikely to happen unless they do another foreclosure freeze. Because, again, what we talked about earlier in this video, the unemployment rate is ticking up ever so slightly. We're at about a 1.5-year high. CPI number ticked back up from month to month. Things are headed in the wrong direction everywhere you look. So I seriously doubt we're going to see a big surge in home prices. I don't think home prices are going to crash, but I don't think they're going to go up like this Business Insider article is talking about. U.S. home market is effectively frozen, but home prices could rise, says Jenna Stauffer. The real estate expert says a lack of inventory and affordability is weighing on the sector. Yes, right now there's a lack of inventory, but when people get laid off, when layoffs accelerate, when we see unemployment number hit 4, 5, 6, 7, 8%, that's going to go above that too. I'm talking about the official number. Then you're going to see a lot of homes hit the market. Simple people basically won't have any choice. They'll have to put their home on the market. It's either that or default and just let it go into foreclosure. So you're going to see panic selling. We're not there yet. I think we're still probably 6 months to 8 months away before you really start seeing a lot of inventory pile into the housing market with homes for sale. One more here. Study finds 75% of banks didn't hedge for higher interest rates. Unrealized losses on securities, 516 billion at the end of the first quarter. That's a study that just came out. It's talking about the first quarter. It's actually gotten worse since then. But banks, yeah, they didn't hedge for higher rates. And it's pretty interesting that people treat low interest rates like they're here forever. Um, and the jobs that are created with low interest rates and people borrowing money, which when people borrow money and spend it, that creates jobs. It creates a lot of economic activity and money velocity. But now the opposite's happening. High interest rates, things are slowing down. Job losses are mounting, layoffs are mounting, and things are just going to accelerate to the downside from here, everybody. So I hope everybody liked this report. If you like this channel, please help keep us alive by subscribing. Please subscribe. More than half of you watch these videos pretty consistently, but you're not subscribed. Please keep us alive by subscribing. I'm begging you. Thanks, everybody, for being here. As always, big love. Keep stacking. Bye for now. Peace.